So, Sarah and Eric, thank you for coming on the show. Today, we're going to kind of do a slightly different format in that usually we're speaking with one person, but today we're kind of having a roundtable conversation about the world of independent financial advisors. And so, I think we can go, we'll start with I'm going to say this might be the oldest person in the room, and it's not me. I want to start with the person with nearly 40 years of experience. So, Mike, can you introduce yourself briefly, and next, can you just explain like what has stayed the same in that time, what has changed from your perspective on the markets, on being an advisor, etc.
Well, it's clearly that I am certainly the oldest person in the room. Whether that's good or bad is another answer. And I spent 34 years at one of the big banks, and then I left the big bank and went independent. While and I might add my peers who had also been just at one or two of the big banks were there, we thought that's what the world was. We didn't know there were independent people. We just and we you know we thought we're a big bad bank and nothing else mattered. So it was an interesting transition to observe the entire world of financial advice once it became independent. But as this is a somewhat long answer, so don't hesitate to kind of cut me off if you want to. But what has changed over the decades has been the number of financial advisors has exploded. There are so very many more financial advisors of all shapes and sizes doing all kinds of different things under the guise of being financial advisors. That's one thing that's changed. Another thing that's changed is, if you can believe it, right after I got in the business was when 8% front end loads went away. So there were guys in my office when I first started who had 2 or 3 years prior sold mutual funds with an 8% front end load. So the cost changes have been very, very dramatic. And the third thing is the range of products, right? In the 70s and in the early 80s, it was just stocks and bonds. And then mutual funds got introduced, and then annuities got introduced, and then fixed variable annuities got in. So the range of products and the rise of the indexes and the ETFs, the range of products has increased dramatically. What really hasn't changed is in every case, it's still you're dealing with the needs of clients. You just have a lot more tools in the toolbox to deal with them. At the end of the day, all the derivatives excluded, all the annuities, mutual funds, and the like, it's still just stocks and bonds. Maybe they're public, maybe they're private, but it's still just stocks and bonds. It's ownership or lending money to corporate America in one way, shape, or form. Mm-hmm. And the other thing that has not changed, it's evolved, but hasn't changed, is so much of what we do is dealing with tax management needs. That tends to be something that I nerd out on quite a bit, but it's always been the case. Even at the beginning, when Roth was a brand new introduction of a type of an account, the tax dimension has always been a factor. So that's kind of what's changed and what hasn't changed over my career.
So I want to go to you next. I want to ask you perhaps about what has changed, but if you could give us just an introduction to who you are, and then also I want to talk about the F words, right? Fiduciary, maybe fee only. Could you give us an explanation of what that is and how that's different from like a broker's role?
Sure. Thank you. So I am Sara Craven. I'm Chief Wealth Manager at Sandhill Global Advisors. And one of those F words, which I'm very passionate about, is that we act in the role of a fiduciary. So what that means is that everything that we do for clients is in their best interest. It's full transparency. We are avoiding conflicts of interest and disclosing everything. How fees are paid within the portfolio, how fees are paid to Sandhill, and I expect we'll get into that in more detail a little further in our talk. But really where I sit is as a fiduciary advisor and beyond the day-to-day investment management that my team does internally here at Sandhill. I really focus on the full spectrum of wealth stewardship, right? Integrating aspects of estate planning, tax strategies, as Mike has highlighted, philanthropy, really educating the next generation. And importantly, and something that we're talking a great deal with clients about, is family governance when we're working with multi-generational families. So as you know, their trusted advisor, I'm helping clients navigate those challenging financial decisions and sometimes also personal decisions when it comes to family governance. And so that these families can move forward with clarity, purpose, and care when it comes to the passing on of their legacy for years to come. It's a space that I love.
Thanks, Sarah. Eric, I want to shift to you. And Mike alluded to the fact that there are a lot of different types of advisors. Some of them are at big banks, some of them are not at big banks, and they're independent. And I'm curious, like when people start to work with an independent for the first time, is there a difference that they tend to notice?
Yeah, absolutely. Well, first off, I'm Eric Schei. I'm senior advisor with Gates Pass Advisors. Um, Absolutely. With an independent advisor, they kind of have a wider range of what can be offered. A lot of times when working with a big bank, one of the big wirehouses, it's kind of stuck in a box in terms of the products that they offer, and they're incentivized to sell their products. So honestly, when I'm sitting down with new clients or prospective clients, like really, I hear most often like, "Oh, this feels different." And really, what they're picking up on is that the conversation isn't really about selling anything at that point. It's about them. When I sit down with a potential client, you're not being funneled towards a product or a platform or just trying to like be sold a product. Um, you're you're getting someone who's actually listening and asking better questions and really trying to understand your life before talking about your money. And people feel that shift right away. It's a slower, more thoughtful, and it's really more centered. As much as it's about your money, it's more on a bigger picture. It's about helping you make good decisions that are right for you and your family. And like I said, not selling a product. And for a lot of folks, that's a new experience.
So, so speaking of experiences, right? Like Mike, you've been at both shops, right? If somebody came to you and they're like, "Oh, all right, I'm in between. I'm not sure really which kind of organization to choose. Should I go independent? Should I go, with a big house that has a strong brand and I see their ads on the NFL, so that must be, really strong." How would you say that? What would you say to contrast their possible experiences?
Well, I think Eric hit upon one key, which is I have a far broader canvas of different things that I can offer. Uh, the larger financial firms, will go through a legal process to approve things, but once it's been through that legal process to approve an investment product, they need to make it available to thousands and thousands of financial advisors, and they need capacity within that product. So here's an example. What can you get at Costco versus what can you get at a supermarket or even a 7-Eleven or something? They got to be ready to be able to sell the volume of Costco. So one of the keys of being an independent is I can operate on a far wider canvas of different things that maybe don't have that kind of volume. Same thing with real estate deals, same thing with investment products of all types. So a far less investment restrictions. The second thing is pricing flexibility. Okay. No one, independent folks really can be flexible in terms of how they price things that fit the client's circumstances. When you're working for a big bank, and I'm not suggesting it's not fair or reasonable, but I'm suggesting that the bank's gonna dictate what you can charge for whatever service it might be. And the final thing is, so the firm I was working for was regulated by 11 different agencies of the government. So every month we had one or two or three continuing education things to do, even if we never were involved in those kinds of things. It was what's our CE for this month? So whereas we can go far more narrow and deep with our continuing education now, we have to cover things. We had to cover things that would have never applied to me, but now I can dig in and I can really have a good sense of knowledge on a particular unique area that interests me more. Those are kind of what I see the difference. The difference is independent versus working for a big firm.
Yeah, so you're saying like there's so many different options that an independent can use because they're not, limited to only the things that a bank provides. I'm curious, Sara, is there a method you guys use to, because you got so many more things that you can offer, right? Is there a way that you guys educate clients about all the different things? Is it like here's everything we have, or is it maybe more like a conversational? Actually, I think you'd fit into this type of investment choice. How do you educate
Well,
people?
great question. No, it's really it really is more education around the philosophies of those different approaches. And I think it's also important to know that neither one is good nor bad. It's just about the fit. I think clients may, Eric and Mike have both said things along this line. If you put it into the perspective of, or the example of a personal chef, right? A personal chef, if you have specific dietary needs, whether it be caloric, maybe you're gluten-free, maybe you're dairy-free, you hire a personal chef to really curate a menu for you and your family that best suits those specific needs, rather than you go to a restaurant and you really can only choose what's available, right? So our education is not only describing those philosophical, conceptual differences in care and transparency, and conflict-free approach to wealth advisory. But when it comes to the investment choices and the reality of those differences, I think nothing can be stronger in terms of education than really showing a real world example. And what I mean by that is one of our very first things that we do as we are exploring a relationship with a client is to review the statements that they have, the accounts that they have currently, and really showcase to them, okay, well, this is how you are allocated today, and this is maybe what the fees are within your portfolio. This is how we are different from that. And so really using real world scenarios, I think, can really help to educate and inform on what those important differences are.
Yeah, I guess it like makes it more tangible, right? Because when you give somebody they can see themselves in that situation. It's so much more like, oh, they can visualize it, and then it becomes more real, I suppose.
Absolutely.
Yeah.
Yeah.
You mentioned transparency, right? So actually, Eric, I want to ask you about the transparency element to educating clients on all the different investment choices. And I'm curious, like from your perspective, is there a reason why the transparency really matters?
Well, yeah, particularly in this business, the primarily around the transparency of fees, it's gotten very muddy. To Sarah's point, like just around what you have, how do you get paid what you have? We've heard Mike mention 8% front loads. How many people really know what that is? The fee that you're being charged, I can't think of how many times I've spoken with clients and who have an existing relationship or had an existing relationship, and you ask them what they're paying their current advisors, and you get a lot of silence, hands up, like I don't know. It's because it's money, and it just creates uncertainty in the process. So in particular with transparency for fees, I really just try to make that conversation as simple and unmysterious as possible. Clients should always know three things really. what they're paying, what they should expect to get out of that, and then why it matters. What value is that supposed to add? So really, I just break it down into that plain English. Here's the fee. Here's what you pay me. Here's what you're paying for X mutual fund or ETF or manager or something along those lines. And here's everything that you should expect. And then here's how it helps you make better decisions, reduce stress, avoid preventable mistakes.
Yeah.
And like I said, the transparency on this front matters so much because money already carries enough emotion and uncertainty with it, whether you have a lot or a little. There are emotional ties to that, and we have behavioral biases. But when you take the mystery out of that advisory relationship, like, people relax. Just they know you're sitting on the same side of the table. When they trust that you're being with them, and they believe there's clarity in terms of where the incentives are and what my motivations are, and that clarity builds trust. And trust is really what makes everything work in that relationship.
Do you think that there is a influence of like people watching different things on social media that they come and say, hey, do I have fees being taken from this, or do I have, can I invest in this asset class, right? How much does that influence how you guys have to interact with clients, Eric?
Well, I would say, yeah, people know that financial products cost money, and often, but the hard part is you don't know where to go to find that. So many people don't even know if they have an independent advisor, unless it's explicitly pointed out to them, they probably don't talk about fees much, unless it's in that first contract, and a discussion there, and then they don't think about it anymore. But really, as part of the financial picture, yeah, ask your advisor. It's okay to ask, what am I paying you? How does that change? Where is that? And does anybody else pay you? Kind of one of those F's that you were talking about, that fee only aspect. If somebody's saying that they're fee only, really the only person that should be paying them for your finances is you. That reduces conflicts of interest because they're not being compensated for selling somebody else's product. So that fee only is a clear distinction as well, that you can trust that somebody's trying to limit conflicts of interest and really keep what's best for you in top of mind.
Yeah, Sarah, you're nodding your head. Is the fee only advisor question something that you guys get a lot, or how do you have to explain that to clients or prospects as well?
Absolutely. And I think Eric really hit the nail on the head. We always encourage clients, prospective clients, with any advisor that they are going to speak with, ask the question. Feel empowered and be engaged with your assets. Be engaged with your professional team so that you can make what will feel like a really great decision for you and your family, rather than one that feels a little uncertain or uncomfortable. We are all relationship builders, and I want my clients to feel really good about what they are doing for them, for themselves and for their families. And I get to be a part of that. And so making sure they know they are in charge and asking the right questions, I think, is a great first step in that education.
Yeah. I want to ask about, to Mike, this advisors are going independent, right? Maybe there's a steady stream, but you're an example of this, right? You went from a big bank to going independent, and I'm curious if it's if there's been a steady stream, or are there peaks and valleys? Is there anything that you think is causing that migration from being at a big bank to being independent?
So number one, I can tell you firsthand, because let's see, 5 years less 2 months ago, I went independent, and I can tell you it is extremely hard. It's a really hard move because the bank thinks it's their clients, but in fact, the clients primarily want to go with you, but they throw up all kinds of, it's really hard to do. The reasons, and right now I think it's 50-50 independent versus wirehouse and bank financial advisors. There are a handful of different reasons for a handful of different circumstances. So let me just hit four of them really briefly. The first one is um, because of all the overhead with large investment institutions, because of the overhead, if you are doing less revenues, you are getting paid a smaller percentage of what you earn for the bank. So the larger the revenue, the higher the payout, the lower the revenue, the lower the payout. And as a consequence, those with lower revenues will often leave because they'll frankly make more if they're independent, quite frankly. The second one, and this is important to me, is there are between the firms, the banks, and the financial advisors, there are bound to be issues that things that the financial advisor may want to do personally that the bank prohibits. I published a book. I would have never been able to publish a book at the bank. They would have banned me from doing that. I do public speaking. That would have to be severely reviewed before I did anything. So there's a flexibility dimension. The third one is post-pandemic. A lot of people want to work from home now, or they can work from home. Probably can't do that depending on the financial institution. The final one that I've seen happen multiple times is that a financial advisor who has this strong bond with clients who have seen that financial advisor's kid grow up often wants to bring the kid in, the daughter or son into the business. And I've seen multiple occasions where the firm wouldn't allow it. So instead they go independent instead. So there's a bunch of different reasons for a bunch of different circumstances, but there's a steady flow of people going from the big banks to becoming independent.
I have a question more. So the conversation has been a fairly evergreen conversation, right? These things will be true for as long as there are financial advisors, and they have been true mostly for the last, since ERISA created the financial advisor profession in '74, right? These things are always true, but things that might change a little bit is we've had a bull market for, let's say, the last 15 years. And it's maybe it's a little bit frothy, but I'm curious, how do you guys advise clients about, how do you communicate to them, right? And Eric, I'll start with you about how clients can weather a storm, right? When the market is not good. How do you communicate that effectively so they're not freaking out when Bitcoin falls below $100,000 or when Nvidia's stock price eventually goes down one day? How do you manage expectations, Eric? I'll start with you, and then I want to go to Sara and Mike.
So now, sorry, let's pause. My connection was basically the only thing I caught out of that was let's start with you.
Okay, great. Go ahead. Yeah, I'll start right now. No. The question is, how do you educate clients, or how do you manage their expectations when a market downfall eventually happens?
Well, really, I think as I've been involved with the financial markets and studying that and going through, and I started in this business primarily focusing on just solely on investment management. And I went through and I got my chartered financial analyst designation, a CFA, and just as I'm looking at this, really, it kind of boils down to the markets are going to do what they're going to do. So, where we see consistency in market returns is over long time frames. Where we see unpredictable movements in markets is in shorter time frames. And so, really, the goal in our investment strategies is to structure a portfolio so that you can handle the short-term risk in the market. When the market hits all-time highs, guess what? There's a good likelihood that we're going to see a pullback at some point,
Yeah.
because markets like to go back to their side.
Yeah.
And so they, prefacing, in the short term, markets can go up or down. They can go up or down. We've seen stock markets go up 50% in a year, down 40% in a year. But over the longer time frames, over 5, 10, 20 years, that range shrinks pretty significantly. And so we talk to clients about, hey, what is your plan, and what's your risk, your ability to take risk using all those technical factors, and then what's your willingness to take risk? How much can you stomach in the short term, and how do those come together? And let's structure a portfolio so that you can really handle those short-term swings, that when the market's going up, you feel like you're participating. And when the market's going down, nobody likes it, but you can still buy into that longer-term strategy to take advantage of that long-term consistency. Because really, over the long run, people look for this, what's the secret to success in investing? And most people hear the buy low, sell high. And the only way to really do that is to keep your money invested for longer periods of time. And so we want to structure it so that you can really take advantage of it. And so, I mean, it's almost cliche now, but people really, the secret to success in investing is not timing the market in the ups and downs, it's time in the market, keeping it working for you over that.
Yeah. So think long term, don't get scared. I think that the challenge is sometimes people just, maybe they have emotional responses to news, right?
Mm-hmm.
And they're like, or like I said earlier, they say something on TikTok, they're like, oh man, I should probably put my house into a trust and, making really bad decisions. And I'm curious, Sarah, from your perspective, right? Are there ways that you kind of help people calm down at the same way and be like, you know what? We got to think long term about this. From your perspective, how do you, be the person in their corner rooting them along?
You bet. Eric was spot on. When you can explain the three of us, we've been through many different market cycles. When you can explain to a family that, look, these things are normal, it's quite normal to have a sell-off in the market every bit of time. That, I think, puts things into perspective for them. Because certainly, and I know we've all experienced this, that you'll have a client when we're really in the throes of some volatility, they'll feel like, well, this has never happened before, and I must respond. Whereas in fact, your investment advisor doing a good job for you is monitoring all of these trends and developments, and perhaps doing some important things in the portfolio over time, right? But I think when we are working with a new client, we are going through things such as, what is their tolerance for risk? What is their appetite for risk? Because we don't want clients to be more exposed to risk than they either need to or that they are comfortable with. If we are in the middle of some volatility and a client, makes a panicked call, then we know, you know what? We must not have you in the right asset allocation if you are in this mode of panic, right? We need to assess perhaps a different overall investment strategy is where you may be better served, right? So it's all about that risk exposure and the client's expectation over time that we'll have to go through these periods of time. And knowing how their investment, again, this comes back to clients being fully engaged in their understanding of not only how they are allocated and our investment approach, but that we, their trusted advisor, who's got their eyes on the ball and following these trends, is going to be following a discipline on their behalf. We want to remove the emotional element for them to know and have comfort and guidance that the long view is in play, and we're just in this mode of you're going to hit these pockets every now and then, but we expect that to happen.
Yeah.
So
I want to double click on one thing you just said really quick, which was risk tolerance versus risk appetite. And I'm curious, can you what are the differences there?
Oh, you bet. Okay, let's start with risk appetite. Uh, wouldn't it be amazing if we could count on 40% return year over year? Risk appetite is I want the value of my assets to go to the moon. Um, that is not reality. And in that, when we are in a period of volatility, is when that risk tolerance really can be exhibited, and we as the advisor can really see the emotional aspect that the client is experiencing when we're in that period of volatility. And so, wouldn't it be amazing if we could have all of the upside and none of the downside? The appetite for risk may be, I would really like to see my portfolio grow over time, of course. How willing or tolerant are you emotionally when we hit those volatile moments? Because this is all about sleeping well at night, right?
Yeah.
For individuals and families. If you know that your assets are doing what they are intended to do long term for you and your family, our hope is that you will sleep well at night, having a trusted advisor who is there kind of walking alongside. Sorry, phone is ringing. Aligned with you and your goals, and walking alongside you.
So the appetite is like, oh, I wanna go in all in on this versus like, nah, I'm okay. And the tolerance is like, I can go in on this if I want to, versus like, you might want to invest $1,000 into Bitcoin, but you can't do that.
Well, another really important thing is for families that have accumulated a great deal of wealth, they may not need to. They may not need to have a very growth-oriented account. So, it's we take all of that into consideration. And what I mean when I say they may not need to, they may have accumulated enough wealth to, support what they need as a family, and including all of those longer term goals. So perhaps being more conservative is the right decision for them.
Mike, I want to ask you about indicators, right? I know you're not a big news fan, but how do you make sure you get a good gauge on what is happening in the market and how you can make sure that clients are well positioned? Are there any specific metrics that you use to get a good gauge on the market?
Well, we're going down a little bit different path, but I'll answer the questions and you can decide whether you want these. So I'm very conscious of two or three different things. Number one is the yield curve. I think that is indicative of things, although not as much in the last couple of years, given what's gone on. I will on a daily basis read any speeches done by Fed officials, and then I'll always kind of glance at research on individual companies. But it's the yield curve and it's those speeches that probably are too, and the other thing that I get from some of the research is commentary from company quarterly reports. Those are things that I pay the most attention to.
Yeah. Well, just to wrap up, I want to ask each of you a question. If you were speaking with a client or if somebody came to you asking, hey, what should I ask advisors in order to kind of figure out who I want to work with, right? What is a question that you would recommend they ask of anybody that they are talking with? Sara, I'll ask you first, but again, the question is like, if you were to meet somebody new, what questions should they be asking, or what is one question they should be asking in order to figure out are we a good fit?
So there's a little challenge I'd say, in the development of these independent advisors and a recognition that people can say that they are fiduciaries. I think an important question may be, outside of, what are your fees and how are you compensated, but an important question may be, are you a fiduciary at all times? Understand? Within a broker-dealer arrangement, and Mike, you may know this better than anybody, they can wear two hats. They can wear a broker-dealer hat, depending on the engagement, or they can wear a fiduciary advisor hat, again, depending on the engagement. What I understand of the three of us is we are a fiduciary at all times. So when we talk about being conflict-free, that's conflict-free in every instance, whether it's in the portfolio, in the advice that we give, in the introductions that we're making to other professional team members. So again, other than like the nuts and bolts of questions for any of these advisors, what rises to the top for me is there that bifurcation of their role and duties? Is it a suitability or is it a fiduciary type of a situation?
Thank you.
It would be my feeling that a client would want to work with someone who is a fiduciary, hands down. Period.
Makes sense. Eric, what about you?
Yeah. Real quick, just one kind of explanation that I like to give on that, the difference between fiduciary versus a suitability requirement is fiduciary. Think of us like doctors for your finances. We have to do what we think is what's best for you. On the suitability side, the only requirement there is that it's not wildly outlandish and suitable for somebody of your profile, not what's best for somebody of your profile in your circumstance. And so I like to just draw a clear distinction between that. And so outside of understanding how you get paid and who's your allegiance to, it's going to be what value are you trying to provide to me? Because Mike alluded to it earlier that there are a lot of different people who say they're financial advisors, and a lot of different people saying they're financial advisors do a lot of different things. And so you want to understand really what's your focus when you're talking to somebody. Is it, and some financial advisors are really primarily, they'll focus on a single type of portfolio investment. Like I'm a large cap value manager, and that's the only piece that they're financially advising on. Or you could go on the other spectrum that I'm more broad-based financial planning. I don't talk specifics about investment. So really understand what's the value you're trying to provide to the client, and making sure you have a clear distinction when you're talking to different people what that different value proposition is.
Mm-hmm. That's simple. Oh, Sarah, do you have another thing?
Yeah, something that Eric just said reminded me of this. I was with a client and her daughter on Wednesday of this week, excuse me. And the daughter is not a client of mine, but mother is. And the daughter said, "Hey, can I ask you a question? I'm needing to make donations to my daughter's school. And I'm thinking maybe I set up a charitable lead trust to make donations to the school. What do you think? Is that a good idea for me?" I could have easily said, "Oh yeah, sure. And we'll manage the assets for you and let me introduce you to an estate planning attorney." Mm-hmm. But instead, I had to tell her, I can't really tell you if that's a good idea for you without understanding your entire picture, your goals, your assets. She had it dialed in. She knew exactly how much money she wanted to put into this lead trust. And I had to tell her, if you're wanting my advice, we need to set up a call so that I can give you my best advice given your total situation. I think that and it's, we've all been to that party, that cocktail party or that dinner party when somebody says, "What should I do?" on XYZ. as a thoughtful wealth advisor, I think the proper answer is I can't really tell you without understanding what
Yeah.
your needs are and where you're intending to go long term.
Yeah, that makes sense. Mike, what would you say one thing people should ask?
Well, I'm going to go down a totally different direction, but it's going to draft off of what Eric said. I'm going to say in a very disarming way, tell me your last few things you've done from a continuing education perspective. From that, I'm going to learn if this person loves to do annuity types of products. I'm going to learn whether they're portfolio management types or whether they use separately managed accounts. I'm going to learn a lot of things if they tell me what the last 2 or 3 CE courses they took are. And it's going to be disarming because, again, back to my original point, we can broadly talk about all the different tools that we have in our toolboxes, but unless we really know something about them, what's the point? So I'm going to ask about CE, typically.
So this is you as an individual. Our hypothetical individual is saying to the advisor, "What's the last CE or 3 CE courses you've taken?"
What are you learning now? I mean, not what you learned 10 years ago. What are you learning now? What are you interested in now? What's the last series of CEs you did?
Yeah, cool.
Because Ryan, one of the things we both know is
yeah,
continuing education is a very low bar out there. You can speak to that more than anyone here.
Yeah, it's more a process of making sure that you're submitting the application correctly and paying the right people. But anyways, how can people get a hold of all of you if they're interested in getting getting some advice after the cocktail party, right? I want to know, should I set up this remainder trust? Well, okay, what's the best way to get in contact with you guys, Sarah?
Great. All the normal channels. Email, phone. We're still finding that clients like to have Zoom meetings, which is great. We're meeting in person. I can be found on LinkedIn. So any manner of or modality of contact.
Beautiful. Eric?
Yeah, I'll say same as well. If you don't have the personal information, email, phone call, that sort of stuff, you can always go to gatepassadvisors.com and everything's up there. And
Cool. Mike, you're on Twitter. What's your Twitter handle?
No. We're not talking about Twitter. I'm in Twitter as an author.
Oh, okay.
We don't talk about financial advice on Twitter.
Oh, okay. We'll stick to email, I guess. Maybe LinkedIn.
To both Eric and Sarah's point, if you Google me, I got a lot of links. If you go to the My Lattice Wealth website, you can get a hold of me. You get a hold of me on LinkedIn. I check that regularly. So all the different channels. I would say for all three of us, if you want to find us, you can find us.
Yeah, you can find us. All right. Thank you guys for your insights today, your provocative thoughts, and we will leave it there. All right. I'm going to stop it.